We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Britton Financial Partners.
We have Jonathan Tulub. Do I have to go for pronunciation there, JT? Good.
Excellent.
As he's
better than I would do. Yeah.
As he's affectionately known by, well, I don't know whether it's family or just us. I've just taken to calling you JT. I assume that everyone else does call you JT as well. But you're back on the podcast, JT. We had you on episode number 92, and we're a bit tight for time, and Ben wanted us to get straight down to business in markets, and we didn't spend any time talking about you and maybe Investsense and the connection with Investsense and Burke Britton and their clients. So we're back again. I thought maybe today we'd do a little bit of not too much of a deep dive, but we'll go back and get a little bit of your backstory for those clients that are listening to this, that hearing us talk about Investsense and SMAs and the benefits of that. They also like to know who it is that's running the show behind the scenes, who it is that sits on our investment committee and provides that research, and who it is that we speak so highly of. So let's hand over you to JT. You can go back as far as you like, mate. Whenever we have Peter on the podcast, he goes back about 3 generations. You don't have to go back that far, but tell us a little bit about yourself, where you grew up, where you're educated, and ultimately how you ended up with Investsense.
Yeah, sure. So thanks for having me again. Honored and delighted to be here. I grew up in France, in the southwest of France, city called Toulouse. Look, a very, very nice, not so little city, small by Australian standards maybe, but like kind of the 5th or 6th largest city in France. Really a really nice place to grow up in. I don't know why, but I never thought I would stay there. It's a great place to grow up with, but I guess I wanted something a bit bigger. My parents kind of pushed me to go and study abroad, mostly so I would have a good English. So I went to New York when I finished high school, started college there. Not really with the intention of finishing it, but just I said, like, I'd spend a year abroad, and while I'm there, I might as well do something. So I enrolled in university, and then I enrolled in a finance course because that's kind of what I was interested in, and really continued to like it, like the environment. Also realized that if you studying finance in New York, where Wall Street is, maybe it's worth sticking around a little bit. And so that's what I ended up doing. I finished my study there, started working for a few investment banks. Ended up spending 13 years altogether in New York, which were fantastic years, and really learning about the investment world with first-hand experience in different asset classes. I traded bonds, I traded options. I had an experience in fund manager research as well. Along the way, I met my wife in New York. She happens to be Australian. And, after a little bit of staying in New York together, we decided to make the move to Australia. So we've been here now the last 13 years. And once again, it's been a really good, next step, a much better place to kind of put down some roots, grow kid, have a family. And that's been the personal journey.
What did your folks do, by matter of interest, JT? What did your folks do?
My dad's a dentist. Very, very recently retired. He retired, I think, 9 months ago. Look, like that's one of those careers where you do it kind of from day one. So he's never done anything else. Interestingly, he's a bit. One thing that's a bit different about him as a dentist is always worked alone. So I know it's almost unheard of, but he never had a nurse. He never had someone to pick up the phone. So he was kind of a one-man band doing literally everything in his practice, and he always wanted it that way. My mom had a few different careers. She worked a little bit in marketing and advertising, and in professional development is where she really probably spent most of her career, as well as looking after us.
Awesome. I think that background in the Wall Street stuff I found fascinating. And is that where you met, again, correct me if I'm wrong here, but met other business partners for Investsense? Did you work with JL, or is that where you guys came together at that point?
So it was when I landed on
JR, sorry, JR, not
yeah.
JR.
So Jay, just to answer another one of your questions, the nickname JT only came about once I met JR. So basically, there were two Jonathans in the business, and I had to differentiate them. So one was JT, one is JR. No one before that point ever called me JT, but now it kind of stuck. So, and I'm very happy with it. So definitely not pushing back.
You might have noticed that in the office as well, and it's always been the case that Peter's always been PB. So the original business was PB Financial Solutions, and Peter always tried to tell us that it had nothing to do with his name. It was an abbreviation or an acronym for personal best. I said, I don't think that's true. I think it's pretty reflective of you, Peter. But anyway, PB, I'm JB. Delta's DS. Benji get BK much, or probably not so much.
Not as
it's
much.
Starting to creep it. It's creeping into the vernacular now, but I like the abbreviated names. It suits you anyway, JT.
It's a very Australian thing to kind of abbreviate everything and give nicknames. But in New York, no one had any trouble calling me Jonathan.
We're pretty lazy here.
Three syllables. Lazy. 3 syllables. Exactly. I met.
Sorry, you go, JT.
Really my first job in Australia. So when I arrived in Australia, the first job I had was with a research house called Van Eyck, that people who've been in financial services and in especially in the advice world would have known from a few years ago. Yes, I was hired actually by JR to be part of the asset consulting team there. So it was him, myself, and Phil, who were kind of the senior people in that team. Our role there was to essentially build portfolios for advisors, for clients. Very much the same thing as what we're doing today in terms of the actual work, the intellectual property is very much the same. Maybe that's a transition to the next few questions that you may want to ask, but what happened is, well, first of all, we were very happy working together and, a very good relationship. And that's obviously the start of everything. And have now been in business at Investsense together for almost 10 years, with, between 2 and 4 years working together prior to that. So we really know each other for a long time, and coalesced around an investment philosophy, which hopefully we'll get into it as well. And is an important component of that relationship. What changed is, at the end of the day, what we were doing was interesting and I think valuable to the clients, but difficult to implement, right? So you remember those days, you have a portfolio, and when the consultant recommends that you make a change to that portfolio, it's very clunky to implement that change across all of your client base, and you have to do an ROA and really could take 3 to 4 months before you go through all of your client base and to implement it. So we found ourselves really constrained by that implementation problem. And around the same time, SMAs, so separately managed accounts, started coming onto the scene, which is really a technical, or technological solution that solves this problem. And we thought that would definitely be the way of the future. We kind of started doing it a little bit at Van Eyck, and wanted to push that further. The firm was not interested in going down that route, and which is why we decided to step aside and start our own business, really focused on that.
So that genesis of Investsense about 10 years ago. So it was JR, yourself. Was it just the two of you at that point? So maybe from the point.
No, and Phil Andronico.
Okay.
I don't think you've met yet.
I'm not sure. I've met Phil a few times. Yeah.
He's the only Australian in the bunch, so.
When did Paul come on board? When did he come into the mix?
Yeah, a little bit later on, so probably 4 years into the journey, I think. You learn a lot from your mistakes, I guess. But we were trying to do everything, just the three of us. which means, doing a lot of market research, running an asset allocation engine, and, managing client relationships, as well as, hunting for new clients. And I guess, out of those things, there was maybe the last one was we were doing a terrible job at. And Paul approached us. We'd met Paul from the industry. He just finished up at, Paul was the head of distribution at Russell. When he finished that, he approached us immediately saying, look, I think your business has a lot of potential, but you really need someone to distribute it. And that's where the relationship started with Paul.
How long ago was that? You said, was that how many years ago was Paul? Did Paul come up?
That's probably now close to 6 years ago. Yeah.
And then Paul's background, again, without talking about him too much, but he's not here, but background was more direct to, he had been in the planning world directly with clients back historically. So he probably tied in that other end of the equation and bringing that back through to your technical knowledge.
Yeah, no, absolutely. I think Paul was a financial advisor for 17 years before moving on to the distribution side. And I guess that gives him a lot of authenticity when he speaks to you guys. He knows what he's talking about. He knows what you guys deal with every day, which is something that cannot be said for me.
So
I think,
maybe talking
again,
about
sorry, Joe, you go.
So you go. No, you go, Ben.
No, I was going to say, I suppose then linking that through to how we get to sitting here today is, again, meeting with Paul and him understanding the challenges in our world of, and again, we touched on it just before about documentation and timeframes and how we went through a very long process. I think it was probably all of 2 years, to be honest, to get to the point where we launched with you guys, which, again, from our perspective, we want to make sure we know exactly what we're doing, why we're doing it, and who we're doing it with. So, again, that's going really well. We're nearly a year into that, probably not too far away from that being a year on. So getting really into the swing of things. And I think clients starting to now see the benefit of that coming through in their portfolios and getting that bit more active management without being in there playing around with things all the time. So I suppose, again, we sort of weave our way through here to explain, I suppose, what, first of all, a separately managed account, an SMA for what usually gets termed as, actually is, and from your perspective and our perspective and the clients, I suppose.
Yeah, sure. Look, an SMA is, for us at least, or the way we started looking at it, is the best solution for all parties involved, right? It is not something that is designed only for advisors. It's something that is designed for advisors and for clients, right? With clear benefits to both parties. What it is it allows the clients to have holdings into their own name, right? So a client still maintains their own account and they own everything that's in the portfolio directly. So, right, so if BHP is part of the portfolio, then when the client logs into their account, they can see that they're holding that much of BHP and that much of Rio and that much of Westpac, etc. Now, the right to buy and sell is delegated to an investment manager, which in this case, you've chosen us as the investment manager for your managed account, which means that when we want to, sell Rio and buy BHP, we do that at the, the head level, if you will, and the transaction automatically flows down to all the client accounts simultaneously. So the clients only have to buy into, from a documentation perspective, buy into the SMA at the onset, and understanding that they are delegating some responsibility to the investment manager. And the benefit is that the speed of the implementation is immediate. And the benefit from you is obviously, for you guys, is obviously, more efficiency, being able to look after the clients better, and also, introducing a level of professional management into the portfolios. The benefits from the client, in addition to the speed of implementation, is tax benefits, right? Especially when we're talking about the direct share component of it. The big difference between owning BHP directly and owning a fund or an ETF that owns BHP is that, in the latter, you could be subject to taxes, capital gains taxes, while you haven't experienced the actual gains. Whereas when you own the shares directly, that cannot happen to you. So look, from all those, did I do a decent job at explaining what an SMA is, or am I missing something?
Yeah,
no, I think it's good. I think that's, and I suppose from in reality, the decision-making process around that probably gives some clarity to it as well, is that, as a minimum on a quarterly basis, we have our investment committee meetings. And I suppose an important part of what we did and why how we've structured this is to maintain the Burke Britain feel to what we do, as well as taking on your expertise. And we found that was a pretty seamless sort of blend between them anyway, which is why we're here today. But, setting that meeting out, we run through very detailed analysis, and you present that to us from a macro level down into the individual holdings that we have. Any changes that are proposed, there's a sort of a voting system where we maintain 2 votes and you have 1. We haven't had any disagreements yet, which has been good. So there is a process. There's not just a freewheeling of trades happening behind the scenes. There's a process. Peter and I are the 2 committee members at the moment. So with JT and Peter and I making those votes, that's when we then ratify the changes and JT implements off the back of that. So it's not a daily trading activity. It's structured at quarterly, but we can put out little fires if anything arises or opportunities arise as well in between times, which is where, again, more adding back to that value is we're just so much more nimble than we've ever been before, but still aligning to the client needs and goals that we understand and have built up over decades.
Yeah, no, absolutely. Like that collaborative aspect of it is, I would hope, a hallmark of Investsense and what we're trying to achieve with all of our clients. And it's exactly as you describe, sitting together investment committee levels, and sometimes the ideas come from us, sometimes the ideas come from you, and we have to do a bit of extra work and analysis on it. But that's all working together toward the same goal. The way I tend to think about it is we're going to do a collective job properly only if we can have that unbroken chain of a communication between ourselves, the advisors, and the clients at the end, right? So the goal here, our job, is to, quite simply help your clients retire, achieve the investment objective, and maintain their purchasing power, basically, after and well into retirement. The best way, like, there are many ways to do that. There are kind of many roads that lead to Rome, if you will. But for us, the biggest danger to that objective, the biggest risk, is clients buying into something that they don't understand. Because what happens then is, inevitably, at some point in the investment cycle, we're going to hit a snag, and a pretty big one. And, it could be COVID, it could be GFC, it could be 1987 crash, pick your poison or pick your crisis. But at some point, these things happen every 10 years, every 20 years, and they actually seem to be happening with more and more frequency. Now, if that's an inevitable part of the investment journey, the risk is, if clients didn't understand the potential downside risk when they bought into the value proposition in the first place, that can be quite scary, right? Like seeing your life savings go down by 30% is inherently scary. Now, if it is something that was flagged in advance and there's a full understanding of it, the client buys into it from the beginning, then we think you greatly minimize the risk that the client will do the worst possible thing, which is pull the plug at the bottom, crystallize the losses, and not benefit from the recovery in markets that inevitably tends to follow a crisis. And the best way that we can achieve, or that we can prevent that risk, is through transparency and communication, right? I mean, we'd like to think that we will add value as well on the investment side of things, but first and foremost, the client has to understand what you're saying, and you have to understand what we're saying, right? And as long as and it has to be an understanding rather than just a leap of faith. If you face your client and say you should trust Investsense because they're really good at what they do, and it stops here, that's not really understanding. That's just believing, right? Whereas I think if you are able to explain, hey, here's what they do, here's why they invest in, Japan at the moment, which is a bit out there, or in emerging markets, and hear why they see value into it. Oh, and by the way, if that doesn't work out, this is the potential downside, right? Like this is the risk that they're taking for the potential return, right? Then I think we're on a level playing field, and we're all working together.
Yeah, I was just going to say, as you were talking about that three-way communication, I had a couple of client queries of recent time about the contrast between managed funds and SMAs as we're actually presenting the opportunity of the SMA and the benefits thereof. You talked about obviously the tax benefits of the SMA, but I think that you said it better than I could ever say it, that level of communication, the three interested parties, the investment manager, the client, and the advisor, when we actually do have that communication, I mean, the ability for us to design, create, and alter portfolios based upon what we know our clients actually need is critical. And again, we have a relatively small group of private clients that we know intimately, but it's that intimate knowledge that we can transpose up and across to our investment managers, and also then relay down to our clients. I think the value in that is something that we place great value in. And I know as our clients become more familiar with Investsense and yourself, JT, and the team, and also investment philosophy that we follow, that will become more self-evident. That might be a nice segue into just sort of the investment philosophy. I know we maybe at another time we can do a super deep dive into this, but maybe at a high level, talked about structurally what the SMA looks like, the benefit of communication. But let's talk a little bit about the investment philosophy specific to Investsense.
Sure. It just something that you said kind of remind me of on the communication side. What's important in there is that it is a two-way communication. And so as much as there's information coming from the investment manager to the advisor and to the client, there also has to be a feedback loop from the client to the advisor and back to the investment manager. And if we're doing something in the portfolios that your clients really don't understand, then we can't do that, right? And so, I might think I've found a very clever solution and some esoteric product that will, solve everything. If your clients don't understand what this thing does, then we're back to square one, where the client has to believe in what we do rather than understanding it, and we know the dangers of that, right? So, as I hope that some of your clients are listening to us, this is really an encouragement to say, please speak to your advisor about the investments. Let them know what's going on. What are your fears? What do you like? And you bring that to us at investment committee level. Now, onto your actual question, the investment philosophy. So there's a couple of points that I wanted to mention. Maybe start with the overarching principles, of which I think there are three, and some of them we've already touched on. The first one is the need to be forward-looking in investments, right? So we all know, if you read all the disclaimers, they say past performance is not indicative of future performance. So we're very familiar with that concept. In our world, what that means is you can't rely on long-term historical returns, right? If you want to know how much are we going to earn from Australian equities in the next 10 years, looking at what Australian equities did over the last 10 years, the last 20 years, the last 30 years is actually not indicative, right? There is no correlation between that. And so that's a kind of a starting point. We need to be forward-looking in our views in order to be able to make those asset allocation decisions, to know how much should I put in Australian equities versus how much should I put in international equities, as an example. Now, unfortunately, we don't have the crystal ball, right? So it's nice to say that, I want to be forward-looking, but you have to have some methodology. And so then we're getting into kind of the second pillar of our investment philosophy, which is, maybe the most complex one, the actual investment engine, which sits on a valuation methodology. And what that means without getting today into the weeds and the technicalities of it, is that we're trying to ascertain objectively, what's the reward and what's the risk from any potential asset. Now, you might think that you need a crystal ball for that. Actually, you don't, right? There's a lot of information and objective information. That's the most important, right? It's not us thinking is kind of finger in the air. What do we think is going to happen, and where interests are going to go, and where the currency is going to go. A lot of factors that we actually are unpredictable in many ways, and that's not at all what we're trying to do. What we're doing is taking the available data today, and in that there are signs. There's not signs. There's a method to derive a long-term expected return. How much should I reasonably expect from that asset class based on all the information that's available in the pricing today? And that methodology actually works really well. Like I can show you, kind of how historically it has worked. There's only one main trick to it, is that it only works in the long term, right? So it's very good at telling you in 10 years time, your average return from Australian equity is going to be, let's call it 7.5%, and by and large, it's going to be, somewhere between 7 and 8. What I don't know is how we're going to get there, because it's definitely not going to be 7.5% year in and year out like a term deposit. It's going to be plus 20% this year, minus 30% next year, and and the ups and downs of an equity market. But point to point, on average, it's going to be around 7.5%, and that's very valuable information if you have a long-term investment horizon, right? And so I think that's the best we can do. We can't predict anything over a short period of time. We can only predict things over a long period of time. And therefore, we have to be patient, right? We're going to make investment calls that may not work right away, that may take a few months and maybe a few years to actually play out. But ultimately, we kind of know where we're going. So it is a long-term investment philosophy from that perspective. In the meantime, we're back to the need for communication and transparency, which is really the third pillar. And you can understand how now it's not just a nice to have, it's actually integral to the whole process, because if you're going to make a decision that may be contrarian, right, like maybe out of consensus, and that may not work very well at the beginning, then you have to make sure that you've explained that to your clients, that they understand, that they buy into it, right? And I think the transparency happens naturally within a managed account, within an SMA, because the client can log in and see exactly what they're holding, and that's good. But also you have to be able to explain all of that so that they don't get scared by those holdings and by the market movements in the short term. So that gives you kind of a bit of an overarching philosophy. In practice, I'd say a few things I wanted to highlight. Number one, that we are very open-minded about what type of instruments we put in the portfolios, right? So we're essentially looking at, everything and anything. So they could be direct shares, they could be ETFs, they could be managed funds. There's a mix of active and passive, right? Following the index or paying a little bit of fees and give it, give someone, a professional fund manager, the task to manage a portion of it. We want to be able to use all the tools at our disposal, with the kind of dual objective of trying to minimize cost as much as possible, and obviously trying to achieve the investment objective while taking the minimum amount of risk. That's also kind of important. Transaction costs are important. So you mentioned, we are very nimble with that SMA structure, which is true. But you got to be careful that every time you trade, you incur transaction costs, and what really so kind of eat into your long-term returns a little bit. So we don't necessarily make changes every quarter, actually far from it, and we tend to make changes only when we think it's really worth it, basically. At a high level, that would probably be the main things I would think of mentioning.
Yeah, and for those clients that have been fortunate enough to sit in front of Dan and myself, we've maybe showed them the valuation dashboard, which I think if you're a client listening to this and we haven't maybe shown you the valuation dashboard when we've talked through the SMA, we haven't had that opportunity yet. I think that's a very, very nice way of understanding that risk reward and over time. So it's exceptionally well presented visual that sort of helps you understand the decisions, the underlying metrics behind those decisions. It's great.
Yeah, when thinking about this podcast, I was thinking, how it's primarily audio. How am I going to explain the valuation dashboard, which, as you say, is very visual? Look, one of the examples that we try to use to understand conceptually, we know what the valuation dashboard does, or what it tries to do, is the following. Let's imagine you've retired on the 1st of October 1987. And you have a lump sum. I know that's not how retirement works, but let's assume that you've just retired and you have like your big lump sum of money that's been sitting in cash all along, and now you go and you invest in markets, right? And you put it all in equity markets. This being October 1st, a few days later, there's the famous Black Monday, October 87 crash, and kind of like at the very beginning of your investment journey, you've lost 40% of it. The math on that is that even if you stay invested in the equity market for 30 years, you don't really recover from that mistake. And you would have been better off on the 1st of October putting all your money in bonds, which theoretically are much lower return potential, right? On the flip side, if you're the lucky guy who retired on the 1st of November, your returns are going to be astronomically higher than the long-term averages. And essentially what we're trying to achieve is to figure out what's today's starting point. You wake up every day and say, what is my starting point today if I'm starting my investment journey, right? Are we on the 1st of October, or are we on the 1st of November 1997? Now, in real life, there's never as clear of an answer as those two extremes, and most of the time you're somewhere in the middle. And also, you can derive an answer for, let's say you would have run that process, and you would have. It's not that on the 1st of October that the crash is around the corner. Is that you can observe that equity markets are expensive, and therefore your future expected return is low. Now, you don't know that it's going to crash and then recover. It might be that, or it might just like stay flat for a very long period of time. But the reality is, like in the price of today, in the valuation of today, you can see that your returns are not going to be high. The issue, though, is that you could have come to the same conclusion on the 1st of October 1986 and probably 1985, right? So you would have naturally been more conservative for a couple of years until the crash eventually happens, and you take that opportunity to become then more aggressive, after the stock market has fallen. In essence, that's what the dashboard allows us to do by putting numbers on those concepts that I've just mentioned.
I think with that, and again, it's all about that moderation, isn't it? Like, it's not, at no point are you going to be completely exposed to one asset class also. So, and again, this is probably something we've talked a lot about with clients, is about the diversity of their portfolio, but also the different asset classes, different, geographic regions they're invested into, all of those different things, to continue to be involved but not be overexposed. And I think we've talked about this a little bit, and we touched on it in the other podcast about there's always a risk, and we looked at the US as there's risk there, but if we just avoid it until we wait for it to blow up, we could wait so long that we've actually lost more than we would have lost if we'd just been involved. So again, continuing to have that valuation dashboard as something to lean on, and I think the credit goes to you guys that you believe in it and trust it and actually use it. Like, there's people that have lots of valuation methods and they have a system that they say they use, but then they often find themselves, questioning that system and then going away from their fundamentals, and that's when you can get into dangerous areas.
Yeah, no, absolutely. And look, like the methodology behind the valuation dashboard is not something that we invented. It's actually
claim it anyway.
Yeah. No, look, it's it's part of financial academia since the 1960s, so it's not a secret. It's just that in order for it to work, you got to stick to it for long periods of time, and that's what most investors are. Although a lot of them say that, they're not actually that long-term minded. And look, in a way, that's what creates an opportunity for that type of investment strategy, right?
Yeah, I think disciplines, again, there's so many layers of discipline that go into good investing. Like, we find the discipline end of the client being disciplined enough to put a regular amount into their investment. Then there's the discipline in where does that go when it is invested, and then knowing that the management of that is disciplined to perform. And again, there's layers of that. It's not just a one. If you get one part of that equation right, maybe you'll do okay. But if you get all of them right, you give yourself the best opportunity to get the outcome that you want. And that's where I think our role is plugging those gaps and putting structures in place to provide discipline and structure to people to make them have the highest outcome opportunity available to them. Again, that's probably more so what we've historically done. Batting this on the end has given us more rigor to that.
Yeah, and bringing those skills to the investment community as well. Yeah.
Now, people can listen back to episode number 92 where we did. I think we probably asked where are we now on that 1st of October, 1st of November. We won't. People can go back and have a listen. That's a plug for episode number 92. But in addition to our clients, there's probably, I know I speak to many other financial advisors out there who maybe are moving down the path of SMA. We live in a world. Our business lives in a world where we don't operate on a famine mentality. We're very good at what we do. We know that people that will want to deal with us are happy to, and many other people out there are interested in SMA. So for people out there that wanted to get in touch with you or know more about SMAs, whether it be they can come and obviously see us, but where can they find you on the interwebs? If there's a financial advisor out there that wants to talk to you about SMAs and Investsense support, where might they find you, JT?
Yeah, thank you, Jay. In investsense.com.au. So just reach out through our website, and we obviously have a LinkedIn page. It's probably also where we put out a lot of our content. So yeah, in Investsense.
Beautiful.
Either on LinkedIn or on the web. Yeah.
I was expecting you to have a Twitter and a TikTok and an Instagram handle that you throw at us, JT.
No, first of all, maybe we should. But I think actually from our, it's very different our business that we're not kind of directed towards retail audience, and though LinkedIn tends to be where kind of the professional audience is at for now.
Yeah. It is an interesting space. We're dabbling and trying and investigating all of those communication channels because it's interesting. TikTok has obviously historically, everyone has shied away from it. Yet there's been at the retail front for the client-facing practices, a lot of people are using it very well and very successfully to actually disseminate the information. So we won't disregard it altogether. Ben, is there anything else that we need to ask of JT in sort of summarising his background, Investsense, and the support they offer to us and our clients?
I think that's been a pretty good summary. Again, I think we could probably talk about it for days if we went right into all of the micro detail. And I think the key is here that we're just going to be doing these on a regular basis. So as we get questions from our client base and from even just other people in the office, like the admin team are often asking questions and other advisors, we're all sort of always talking about it. So as those come to hand, I think each quarter as a minimum, when we catch up and do a bit of a recording, we'll throw them in there and continue to backfill on information. And things will change. There's always going to be changes with how it's structured at the moment and the order of operations. So we want to keep people up to date with that, and we'll keep taking feedback and passing it through, which I know you guys are very, very open to, which we appreciate massively.
Absolutely. Client questions is great for us. It gives us something to write about, something to think about, and usually we find that if one client in Geelong is wondering something, then there's probably another one in Perth and a few other ones around the country are wondering the same thing. So my message to your clients is please don't be shy. Quite the contrary, ask as many questions as you can, and looking forward to answering them.
Wonderful. Well, thanks again, JT. Fantastic to have you on board. We'll look forward to a round 3 in the very near future. Thanks again for your support, and we'll see you in the next episode.
Great. Thanks so much for having me.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening. Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS licence number 232706.